Moz Afzal, you're Chief Investment Officer at EFG Asset Management. What was your best investment in 2018?
Probably the best investment in 2018 was making a call on the Fed going on pause for 2019 in Q4. So we started to increase our kind of duration in our dollar fixed income portfolios. And that actually worked out very well in the kind of volatile periods of November and December, and obviously so far in 2019.
And where should people invest in the near future?
So we've had a recent amount of results from the FANGs, Apple, Facebook recently. So expectations have been very low going into this earnings season. So we think that certainly technology could do particularly well in the short term, but longer term we think healthcare and healthcare disruption is one of the kind of key themes that we're interested in.
Dow Jones is back over 25,000 points yesterday. Is the worst already over for the stock markets?
So it's obviously difficult to say because there are a lot of big macro risks at the moment. For example, Brexit, China trade talks. So any of these sort of key issues could disrupt the current market sentiment. So we had a good rally. We've recovered from the December sell-off, and so we're now looking forward to maybe a bit of consolidation in the markets before we can see the next move with these big macro issues being solved first.
The American Fed sounded very dovish after their last meeting. Is this sparking another stock market rally?
Well, certainly has today. Last night we saw that coming through in the markets. Certainly for the time being, I think we could continue to see that. Key thing will be the yield curve and how the 10-year treasuries, 2-year treasuries perform over the next few months, which give us further indication whether we're going to say maybe re-stimulus of economic growth in the second half of this year.
So how many rate hikes do you expect for this year?
Yeah, so we don't see any, certainly for the next 3 to 6 months. Possibly we could see one towards the end of the year, but obviously a lot's got to happen before we can make that prediction.
A slowing economy is one of the concerns among investors. Will we have a recession in the US in 2020?
Well, we don't expect recession in 2019 or even 2020. The key driver to that view is the fact that we actually have a general election in the United States. So that will drive economic sentiment probably much more strongly. As Trump wants to get re-elected, he will have to try and engineer strong economic growth.
Let's talk about the Swiss market. How do you compare it to other international markets because of its defensive qualities?
Yeah, and we certainly saw that in October and November, and certainly in Q4, that the real defensive qualities of Swiss stock market came through, and Switzerland outperformed hugely compared to the other European and in fact global markets. So that will certainly keep it relatively firm for the time being while we have this volatile period. The key difference will probably be mid and small caps, where we actually had quite substantial falls. We're starting to see some recovery. I think that will continue for at least another 3 to 6 months, as some of those valuations now look quite attractive.
We saw a rebound of banks, for example Credit Suisse, and cyclical stocks, LafargeHolcim, Adecco. This year, is this going to continue?
So cyclical stocks had a very difficult time last year, so we are seeing some of that rebound coming into this year. I think if economic growth starts to accelerate as we expect towards the end of this year in 2020, then cyclical stocks, certainly industrials, could continue to perform given the bad performance of the last few years. Banks, on the other hand, is still going to remain quite challenging. You know, rates are still very low or negative globally, and the US is now on pause. So that is going to remain a bit of a challenge. That will be offset by the financial markets and equity markets starting to perform a little bit better. So I suspect we'll see some rallies and maybe some improvement following last year's poor performance. But, you know, whether it's sustainable, we are still uncertain about that.
On Thursday morning, we saw watchmaker Swatch reporting a difficult fourth quarter, partly because of a slowdown in Asia. Is the slowdown in Asia and China already priced in stocks like Swatch or, for example, Richemont?
So I think there are two things you need to kind of split out here. We saw LVMH's numbers yesterday, for example, were very good, citing China as being a particular source of strength, particularly for leather goods. So I think that China itself is definitely on a weakening trend and has been on a weakening trend. That, however, how that's translated into the watchmakers remains a little bit uncertain, because I think we still continue to see the electronic trends continuing, people less likely to wear expensive watch on a day-to-day basis. And so I think that trend needs to be separated from the overall trend of China and emerging markets. LVMH told us that actually the trends in emerging markets remain pretty firm at the moment.